lecture, the basic part which I want to tell you is that in the real world there can be two types of companies. Those companies which are listed companies. Public companies are generally listed, but public companies can also be unlisted. So there can be, in real life scenario, there can be two types of companies: listed companies and unlisted companies. Listed companies and unlisted companies. When I say unlisted, now these companies can be public or private. In India, we generally say them as public and private, or in America, we can name it as closely held, widely held, one-man company, as the case may be. So the main bifurcation is listed company and unlisted company. Now the listed company, I will say Apollo Tyres is a listed company. It is a public company and listed. Ranbaxy Laboratories is a listed company. Hindustan Liver is a listed company. Unilever is listed in New York Stock Exchange. General Motors is listed. It means there can be two types of companies. One is listed and second is unlisted. In case of listed companies, we have some positives. If I as a valuer wants to value the listed company, it is very easy for me to calculate the value of a listed company because market prices are available to me. I can directly see the market price and I can directly calculate the value of a firm. It is very easy task for a chartered financial analyst. But in case if I want to estimate the value of an unlisted company, that is a private company or a public company which is not listed and whose shares are not being traded in exchange, so I will not be available with the market price. How can I calculate the market price? Because that company is not traded. Now, in order to estimate the market price, I should be aware of cost of equity because market price can be directly calculated with the help of cost of equity. Now, for calculating cost of equity of that unlisted company, I require beta if I will be using CAPM model. I repeat, my dear friends, my golden words, please be focused. If you miss next 1 minute, you will be out of the game. So please listen to me carefully. I started my journey that if I want to find out the value of a company, it is very easy to calculate the value of a company, of listed company, but it is very difficult to calculate the value of unlisted company because data is not available. So for that, market price is not available, and for calculating market price, I need cost of equity, and for calculating cost of equity, if I use CAP model, beta is also not available to me. So once I am aware of that beta of unlisted company, then only I can estimate market price, and then only I can value the the firm of the unlisted firm. Now, how to calculate beta? Now, my big question to you will be how to estimate beta of unlisted company. This is my big question in front of you. How to calculate beta of unlisted company? You know, we are not aware of beta of a listed company. We are aware of beta of listed company. One student asked me what is beta. I will tell you what is beta. But beta I have told you in portfolio management as well as in the last lectures. But still, because you have asked me, I will tell you what is the meaning of a beta. Beta is the variation in the prices of a stock vis-a-vis fluctuation or variation in the prices of the market. This is beta. Beta is a tool to calculate systematic risk. Beta is being invented by William Sharpe. For beta, we need covariance or correlation or standard deviation. Beta can be calculated with the help of a slope of security characteristic line or with the help of a formula that I have already told you in portfolio management or in lecture number 9 on 10 when I have discussed CAPM. So beta, now the point is I want to calculate the beta of unlisted company because I want the market price. Why I want the market price? Because I want to value that company. So how to calculate beta? Now for calculating beta of unlisted company, I will take the help of beta of listed companies because that beta of listed companies I am aware of. Beta of listed company, I am aware of that. How I can that is easily available to me. The beta of a given company, beta of Apollo Tyres, beta of Ranbaxy, beta of Hindustan Lever, beta of Infosys, beta of Lakshmi Cement, beta of Ambuja Cement, beta of Dabur. I am aware with that. But supposedly I am not aware of beta of Patanjali, because Patanjali is unlisted company. So how to calculate the value of this beta of Patanjali? For Patanjali, I will take the help of beta of Vaidyanath, or I will take the beta of help of Dabur, because they are both the same companies, and I will use some Fair and Lovely and Fair and Handsome, and then I will calculate the beta of Patanjali with the help of beta of Dabur. Now this process of converting beta of Dabur to beta of Patanjali, Ramdev company, this process, this method is named as pure play method. I repeat, the method to convert, beta of, the method to convert beta of listed company, available company, comparable company to beta of unlisted and target company whose valuation I want to do. This process, this method of converting is named as pure play method. So my dear friends, I want to tell you the logic behind that. So please be focused. Supposedly, I want to tell you that beta of Dabur is 2.5. Let it be the case. I am taking a hypothetical example just to explain you. And this beta of 2.5, this is systematic risk of Dabur. This is systematic risk of Dabur. This is systematic risk of Dabur. I can, bifurcate the systematic risk. I can divide this beta, because this beta is due to two reasons. I can divide this into two parts. Beta can be divided into two parts because beta is affected by two reasons. One is due to systematic risk is due to business risk. It means the business in which Dabur is, the business in which Vaidyanath is, the business in which Patanjali is. It is due to that business. And second is due to capital structure mix. I repeat, systematic risk is due to two types of risks. One is debt equity mix, one is balance sheet mix, one is financial risk, and second is inherent risk, that is business risk. So I have used synonyms. You have heard my synonyms. Please be focused. Please be straight. I told you the risk is due to two reasons. One is due to finance, due to capital structure, due to balance sheet, due to debt equity. Because higher the debt, high will be the financial risk, which we will be discussing in leverages. And second is purely due to business model. The model in which that company is, that risk is named as business model risk. That is inherent risk. So my dear friends, I can say the beta can be divided into two parts. One is due to business model, and second is due to financial risk, that is the debt or equity being raised by Dabur. Now this debt and equity raised by Dabur can be changed, can be interchanged, because debt equity mix of Dabur cannot be equal to debt equity mix of Patanjali. But the business risk of Dabur is always equal to business risk of Patanjali, assuming that both are producing the same products. It means tire industry risk, the risk in manufacturing and selling tires of Apollo will be equal to MRF tires, will be equal to JK tires, will be equal to CH tires, and it will be equal to any unlisted company who is also manufacturing tires. But the risk of debt equity of Apollo tire can be different to as compared to Ambuja, or as compared to JK tire or MRF tire or Dunlop tire or CH tire or any new company, unlisted company, because debt equity mix depends upon the balance sheet. It depends upon the financial structure. It depends upon the debt equity mix. Now it can be different from company to company, because it depends upon the philosophy of the management, that how much debt is to be raised and how much equity is to be raised. So my dear friends, I want to again discuss the same concept. beta of Dabur, I will say let the capital structure risk be 1. Financial risk be 1. I'm just bifurcating. And the business risk of Dabur is 1.5. Now, if I want to calculate for Patanjali, again the beta, the risk, the unlisted company, the target company Patanjali, again it can be divided into two parts: business risk and financial risk. Now, my dear friends, business risk of Patanjali will also be 1.5 because it is inherent, it is due to the business, it is not due to any other factor. But this financial risk can be different. Supposingly, I will say this financial risk of Patanjali is 3. Then I will say beta of Patanjali is 4.5 and beta of Dabur is 2.5. But in both these betas, there is one common factor, that is business risk. Now business model is same, inherent risk is same. So I want to again repeat the things. I want to estimate the value of unlisted company, and for that I need market price, and for that I need cost of equity, for that I need beta, and I'm not available with the beta, so I'm taking the help of beta of comparable listed company. And with the help of comparable beta listed company, I am using fair and lovely, I am using fair and handsome in this beta. It means I will be unlever this beta. I will tell you what is the meaning of unlever. Then I will again use fair and handsome. I will relever. I will tell you what is the meaning of relever, and then again I will use some fair and lovely for females, and then I will be getting the beta of Patanjali or of unlisted company, and then with the help of that beta of unlisted company I can calculate cost of equity, and then with the help of cost of equity I can calculate market price, and then with the help of market price I can calculate the value of Patanjali or unlisted target company. So, my dear friends, next 10 minutes I will be devoting in clearing the concepts of these steps, that why we are unlevering it, why we are using comparable data, why we are using relevering it, what is business risk, what are the flowcharts for that, what are the steps for that, what is a beta, what is project beta, how to calculate asset beta. Firstly, we will calculate asset beta, then we will calculate project beta, and project beta and equity beta are same. So please take out your registers. Today's lecture is most important lecture. I'm again telling you that today's lecture is very, very important. So please take out your registers, and I want to tell you that firstly, I will say 2.5. Let it be beta of Dabur. Then I will supposingly debt equity mix of Dabur is 0.6, and supposingly tax rate is 30%, and supposingly debt equity mix of Patanjali is 0.7. Now I want to estimate the beta. I want to estimate the beta of Patanjali because I want to calculate the value of Patanjali. So these are the figures available to me as per the example which I have just given you. So I will firstly start my journey with beta of 2.5, that is beta of comparable listed company Dabur. Then because I will unlever this, because in 2.5 there are two elements. One is business risk element and second is financial risk element. I want to nullify that financial risk element. I repeat, I want to nullify, I want to neglify the effect of debt equity mix from this beta. It means I have to divide something, I have to divide by that effect, because then only I can nullify that effect. So I will divide. 2.5. Now with which figure I will divide, that I will explain after some point, but the figure will be 1 plus, that figure will be 1 plus after tax. That figure will be 1 plus after tax debt equity of Dabur. I repeat, I will divide it. Whenever I want to nullify the effect, I will divide it. I will divide this beta of Dabur with debt equity mix of Dabur. But I will firstly calculate after tax debt equity of Dabur. Why I will calculate after tax, that after 2 minutes I will be telling you. But firstly see the technique which I am following. 2.5 upon 1 plus 0.6 into 1 minus 0.3. Please see the figures. Please use the calculator. I am using the calculator for you. 2.5 is beta of Dabur. Now it is to be unlevered with 1 plus after tax debt equity, and debt equity of Dabur is 0.6. It means 60% is debt and 40% is equity. I have to calculate after tax, and tax rate is 30%. It means after tax is 70%. So I can either multiply 60% with 70%, or for you calculation sake I have written 1 plus 0.6 bracket, within bracket 1 minus 0.3. So that comes to 0.7. Clear TVM, 0.7 into 0.6. That is coming to as 0.42. 0.42. 0.42 plus 1, that comes to 1.42. So I have seen 2.5 upon 1.42. So I'm dividing 2.5 with 1.42, and the figure is 1.76. Please check the calculations. 1.76. I'm again doing, so that 2.45 upon 1.42, that comes to 1.76. Now 1.76 is named as asset beta. Now in this, only one risk is involved, and that is due to business model, that is due to inherent, that is due to business risk, that is only business risk is there 1.76. Now 1.76 will be same for Dabur, for Vaidyanath, for Patanjali, or for all those companies who are manufacturing the same types of products. Now after, again I am writing down in a separate page, 2.5 beta I have, 2.5 of Dabur I have unlevered it. I have unlevered it by dividing with 1 plus after tax debt equity of Dabur, because I want to unlever Dabur beta, so I am dividing it with after debt equity mix of Dabur. Then because I want to calculate now I have calculated 1.76 as asset beta. I want to estimate that how much is the beta of Patanjali. I want to estimate how much is the risk of Patanjali. Now for that again I have to reliver. Because the total risk of Patanjali is more than 1.76. 1.76 only, so only the project is only the asset beta. Now I want to calculate the value, the risk of Patanjali. The risk of Patanjali is due to two factors. One is due to business and second is due to debt equity. Now how much is the debt equity being employed by this company Patanjali? That is 0.7. So 1.76 into 1 plus after tax debt equity of Patanjali. Mind it, now you should be aware that when I'm using for Dabur and when I'm using for Patanjali, when I want to reliver it, because my objective is to calculate for Patanjali, so I'm doing like this. So let me calculate something for you. 1.76 again firstly I will write down the figures. 1.76 into 1 plus, now what is the debt equity? 0.7 and 1 minus 0.3. So like this I have done for you. 1.76 into 1 plus 0.7 into 0.7, that comes to 0.49. 0.7 into 0.7, again I am checking for you. 0.7 into 0.7, that is 0.49, plus 1, that comes to 1.49 into 1.76, that is equal to 2.6224. Now this is project beta of Patanjali, or I can say equity beta of Patanjali. It is equity beta, and this process is named as pure play method. My dear friends, again I am repeating that today's lecture is most important. I have given some case studies on the same, and I hope that you will write down all that. Don't try to be over smart. Please write down. Remember those school days when we were also writing down, then only the concept will be clear. Because today's lecture is somewhat technical. So I hope that you will listen to my voice and you will follow my humble request. I've done already the hard work for you. I've prepared the slides for you so that your time can be saved. And now my request will be to please write down this lecture number 12, great morning learning outcome. I describe and interpret beta, and we will be following pure play method. So start writing, my dear friends. Please sit straight. First point which I have written is, in case of valuing, the same concept which I have just told you, I have written in my own words. If you write down this, the whole concept will be clear and there will be no need to read so many pages of CFA curriculum with smaller fonts. Please read, please write, please write, please write. In case of valuing an unlisted company, valuer, it means you are a valuer, you require cost of equity or market price. It is better if I write down market price, and for calculating market price you need cost of equity. Firstly, I have to say I need NPS, and for NPS I need cost of equity, and in case of, and supposingly I am using CAPM, I need for that beta. So beta is an important number. Beta is an important number which cannot be calculated in case of unlisted companies. Now for that I will take the help of listed companies, then I will modify it, I will use fair and lovely, fair and handsome, and then I can calculate the beta of unlisted companies. So the same thing I have used here, I have given you here, and this method is named as pure play method. So let me write down the case study. I have just given you the case study of Dabur and Patanjali. Here I have written the case study of Apollo Tires and unlisted tire manufacturing company. It can be, you can use it in anywhere. IT company, IT unlisted with Infosys, IT unlisted with Wipro, IT unlisted with TCS. There are different sectors: tire sector, FMC sector, oil sector, gas sector, cement sector, infrastructure, oil, power sector. So I can calculate for each and every company if you know the concept. So please write down this case study. 2.5 I have taken as beta of Apollo tires, and that 2.5 will be bifurcated again into two parts. That 2.5 can be divided into two parts. The first part is due to business model, due to inherent, and second is due to financial, due to capital structure, and due to debt equity. Risk due to financial decisions in the organization, financial risk, and risk due to business model or inherent risk. And now the first risk is financial risk and the second risk is business risk. This financial risk can be maximized and minimized. It depends upon company to company, but business risk will remain same. So I will use this concept for calculating beta of Patanjali or beta of unlisted target company. So please note, write note number 1. Business risk will remain same for the companies in the same industry. So I have prepared a flow chart just to explain you that listed companies Apollo 2.5 is bifurcated like this, and listed company, unlisted company, manufacturing company. So business model of this business risk of Apollo will be same as business risk of this unlisted, that is 1.5. And supposingly I have assumed that financial risk of unlisted manufacturing tire company is 3. That figure I have just taken. So in that case, the total systematic, total beta will be, total levered beta will be of that unlisted target tire company will be 4.5. Now, this process we can easily do with the help of a calculator. There's no need to worry. Just you have to focus on my lecture. Next 5 minutes are more important. In pure play method, in order to calculate beta of unlisted companies, firstly we will try and find out the comparable company. So this is a comparable company. Supposedly I want to find out the intelligence of a class 8 student, then I should find out another class 8 student in the same scenario, in the same family background, in the same locality, in the same school. then only I can compare, 8th with ninth. Or if 8th student is not available, I am available with the 10th student. Now I have to compare 10th class student intelligence with 8th class. So firstly I will take 10th class, I will take the intelligence, and I will put the questions as compared to 10th. Then I will modify it, and then I will switch it to 8th. So it is just like this. So please write down which is exactly same. First step is we will find out the comparable beta, and then second is we will modify that. We will use fair and lovely and fair and handsome with that, and we will unlever it and we will lever it. That I am telling you in the next slide. Part one: how much is beta due to balance sheet, that equity, and how much is beta due to inherent, that is business model. Once we have seen the beta of a comparable company, now we can, what is a beta? Some people can ask me, some students are asking me, what is a beta, sir? Beta is the ratio of variation in the prices of a stock vis-a-vis the fluctuation in the prices of market. The two things we compare. Please write note number one. The company is having high incidence of debt equity mix. This is very important. So if I compare, the companies having high debt equity mix have more fluctuation when the market fluctuates as compared to the companies having lower incidence of debt equity mix. The person suffering with blood pressure and sugar will have a high risk of heart as compared to a person who is not suffering with blood pressure and sugar, and he must the heart disease of this person as compared to this person, there will be high danger, high risk factor in this case, the person who is suffering with high blood pressure and high sugar. So that's the same thing I want to tell you here. So I will nullify the effect of debt equity. Just write down example number one. For example, in case of biotechnology firms, there is a huge research and development involved. There is a huge lead time involved. So the lead time is more, risk is more. It means in case of biotechnology firms, the business risk is huge. If I compare it with business of of FMCG, it is smaller, because in FMCG I can sell the products easily. The lead time is less. So it depends from business to business that in which business we are, because businesses depends upon those factors, the marketability of a product, the R&D factors, and all technology and all that. So now I am coming to the most important slide of this lecture. Please prepare this flow chart, because this flow chart will help you in skipping 20-25 pages of your CFA curriculum. There will be no need to read that if you sincerely write down this flow chart. Step number one, we will calculate beta of a comparable company. Step number two, we will unlever the beta. We are using fair and lovely. We will unlever the beta on the basis of debt equity mix of comparable company. That is, remove the impact of balance sheet from beta. Step 3, unlever the beta. That unlevered beta is also named as asset beta. The name is synonym. Note 1, asset beta is purely business model risk. Now, because we have nullified the effect of debt equity, so step number 4, relever that beta. Again, use fair and handsome for that beta. Now, keeping in mind, because that person is male, now I will use fair and handsome. Earlier I have used fair and lovely, because that person is female, so I have unlevered the effect. Now I want to calculate for male. I will be using the same concept, but fair and handsome, and relever the beta at the impact of balance sheet of that target company, and the net result will be project beta. Now you must be wondering that how we will unlever and how we will relever. For unlever we will divide, and for relever we will multiply, and just see to it. Just see to it. Point number 5, I have given all the concepts. Now to unlever the listed comparable company beta, we will divide, because we have to unlever the listed comparable company. So 1 plus after tax debt equity. And for relever, the relever that asset beta, because I want to calculate the beta, the levered beta for that target unlisted company, I will multiply with debt after tax debt equity of that target company. So it means I have to firstly divide, then I have to multiply with the same figure. Please write down. I know you are writing. Please write down. Please sit straight. Please sit straight and please write down. Calculate project beta, equity beta with the help of following figures. Now you have to calculate project beta or equity beta. That is the net result. So for calculating project or equity, firstly you have to calculate unlevered beta, which is also named as asset beta. Then you will go for levered beta, which is also named as project beta or geared beta or equity beta. So I have given the figures. Please note down, my dear friend. Beta of a comparable listed company is 3, tax rate is 30%, debt equity mix of comparable company is 0.7, debt equity mix of unlisted targeted company is 1.2. So I have written the steps because after that I have given the practice questions that you will be doing in front of me. So please use the calculator in this. This small device is very useful for saving 10 to 15 minutes in your examination. Please use this. Step number 1, we will take comparable beta of listed entity, that is 3. Okay, then we will unlever it. For unlevering it, we will divide it by 1 plus after tax debt equity. So unlever the beta of comparable listed company by dividing by 1 plus after tax debt equity, 3 upon 1 plus 0.49, that is 2.01342. Step 3, relever. Relever that 2.01 by multiplying with 1 plus this. Just see how I have calculated 2.01. 3 is beta, 0.49 is after tax debt equity of comparable listed companies 0.7, 30% is tax rate, after tax is 0.7, so 0.7 into 0.7 comes to 0.49. So like that I have calculated 0.49 to 0.0143. Then I have relevered the beta and I have multiplied with again 1 plus after tax debt equity of target company. Debt equity mix of target company is 1.2, tax rate is 0.30, after tax is 0.70, 1.2 into 0.70, that comes to 0.84. I have already done the calculations for you. Please do it with the help of your calculator. 2.01, then I have calculated 3.75 as the project beta or equity beta of the company. Now please, you have to do now 3 questions, the 3 practice questions I have given to you. Now let us check that whether I am able to clear your concepts or not. So please write down, my dear friends. I have written there. Please write down. Because practice makes the man perfect. Practice makes the woman perfect. Now you have to do those 3 questions. And once you will be able to do these 3 questions, I assure you that you will be able to do in the main examination, in CF examination. So please start writing down. Calculate asset beta and project beta in the following scenarios. You have to calculate asset beta and project beta. Firstly, we will calculate asset beta and then we will calculate project beta in 3 scenarios. In scenario A, scenario B, scenario C. I want to tell you, beta of listed company. CC means comparable company or listed company. CC, TC means target unlisted company. So I have written the 4 for information. For A, beta of listed is 3, debt equity of listed is 1.5, debt equity of target is 0.5, tax rate of is 0.40%. So how I will calculate asset beta? Firstly, I will calculate asset beta, and for that I will divide that beta of listed company with the 1 plus after tax debt equity, because I want to unlever it. So 3 upon 1 plus 1 plus 1.5 is debt equity of 1.5 is debt equity of listed company, comparable company, into 1 minus 0.4 tax rate after tax. That the calculation I did, and 1.57 is asset beta. Now I want to calculate project beta. For that I will re-multiply, I will relever, I will multiply with the after tax debt equity of target company. After tax equity, debt equity is of target company is 0.5. Just see to it. That is 0.5. This is 0.5. Tax rate is 40, so after tax is 0.60 into 0.5, 31 plus 0.30, 1.57 into 1.30, that comes to 2.04. Please do the calculations. I have already done for you and I have told you the steps also. Now I will be doing for case study number B. The beta of comparable companies 2, debt equity of comparable companies 0.5, debt equity of target companies 1.5, tax rate is 50%. I have taken the tax rate as 50%, and I want to tell you something about tax rate, so that's why I have taken tax rate as 50%. Asset beta. Firstly, I will calculate asset beta, that is beta of comparable company upon 1 plus after tax debt equity mix of comparable. So I have directly written as 0.25. So you must be aware that how I have calculated 0.25. How much is debt equity of comparable? 0.5. So zero point 0.5 into 1 minus 0.5 because tax rate is 0.5. So that comes to 0.5. 0.5 into 0.5 is 0.25. Then 1.25. Now how I have calculated 0.75? This is after tax of debt equity. Debt equity of this is 1.5. So 1.5 into minus 1.5, that is 0.5, that comes to 0.75. So I have calculated 2.8 as project beta or equity beta of the company, target company. So like this I am using the pure play method. So let me do the last practice question for you. Beta of comparable companies 1, debt equity of comparable companies 0.3, debt equity of target companies 2.5, tax rate as 60%. So before I give you the solution, I am giving you 2-3 seconds. Please calculate for you with the help of a calculator, because in examination you will be doing with the help of calculator. So let's start today. Come on! Come on! Asset beta. Now it is as 0.89. Asset beta is 0.89. And project beta for the target company is 1.78. So I have given the whole calculation. I have told you project beta, I have told you asset beta, I have told you equity beta, I have told you how to unlever it, how to relever it. Mind you, this lecture is very, very important. Please do it. Please do it. You can save you 6 months. My humble request to you will be, please do this lecture. Be happy, be jolly, be cheerful, be happy, be jolly.